Hello, everyone. Welcome to Rule Classroom Live. I'm Albert Liu alongside Rick Rule on our weekly live stream, which you can catch at ruleclassroom.com. Rick, good to see you. How you doing?
Pleasure to be back with you, Albert. I'm doing very well. I trust you're doing well as I trust you are also doing well.
Yeah, it's a great time of year, Rick. Having a lot of fun. Looking forward to going to Vancouver, seeing you in Vancouver next week. But before we do that, Rick, what's on your mind these days?
Well, a few things. It's been a very good market, Albert, really for 18 months. And things are unfolding very much the way we have discussed in various Rule Classroom boot camps in particular. I need to say, though, that for those members of the Rule Classroom and those people who are listening to this podcast, those who have a trader's mentality should begin to consider lightening up. The part of the trade that has to do with the evaporation of hate, the dead cat bounce in many sectors associated with natural resources has occurred. As an example, the uranium stocks that I bought about a year ago as a consequence of them being hated, I've been selling. That doesn't mean I've liquidated my uranium positions. I had core positions that I added to as a consequence of their oversold and hated nature. I've been an advocate for years of when the reason to own a stock goes away, when it has reached its goal or when it has failed, that you sell it. And the stock that anybody here who, as a trader, bought as a consequence of the sector being unloved is now stock that one should consider taking profits on because it certainly has left the unloved stage. By the way, I'm not saying that the game is over. I believe that the fundamentals are in place for a very long gold bull market, one truly for the record books. I believe, too, with regards to the length and breadth of the resource market, with some exceptions, that we haven't even entered into a bull market in raw materials. I believe that the weakness in the oil price, as an example, suggests that we are maybe not on the precipice of a recession, but actually in one as a consequence of the weak oil prices. And we likely need to get through the backside of that recession before we see a broad-based natural resources market. With regards to the precious metals market, we've gone through the classical first phase, the long base building in gold, then the breakout in gold, then the change in leadership from the metal itself to the best of the best. Now we're seeing the money come down the value chain. And we're seeing it happen with surprising rapidity. Financings that couldn't get completed 18 months ago are now being oversubscribed. High profile investors, the Eric Sprotts of the world, the Rob McEwens of the world, are seeing themselves cut back on private placement allocations. The industry cannot claim to be underfunded anymore. So while I believe that the gold bull market has real legs, and while I believe that money will continue to cascade down the scale, I need to say in the very near term that the market may be overbought. I'm not talking about it from a technical basis. I'm talking about it from the fact that so much money is coming into the trade that junior mining companies in particular are lining up at the trough to raise money, which suggests that they think the money is worth more than their shares are worth, or at least that the money that they raise justifies the dilution today based on what they can do or what they think that the market can do. The anti-US dollar trade, of which gold is a prime beneficiary, is also one of the most crowded trades on the planet. Everybody is expressing their disdain for Trump or their disdain for the US dollar as a store of value and a medium of exchange. And to the extent that trade begins to unwind a little bit, that could be very tough in the near term with regards to gold. I note too that we are truly on a risk-off market, which is to suggest that there's an awful lot of liquidity in the market, and also on a different note that the volatility index, the VIX, has collapsed. That suggests that there's a lot of confidence in the market. Confidence in the market in the near term is strong for US dollar denominated assets and may weaken gold. If the continued speculative fervor continues, it may be that there will be enough liquidity that some of it will sneak into gold and some of it will maintain the gold bid, or rather the gold stock bid, in the very near term. I'm just suggesting that if your orientation isn't an 18-month or 2-year, or better yet, 60-month time frame, that you consider taking the trading profits which have built up. We looked at the performance, Albert, of the stocks that were participants in our 2024 symposium and our 2025 symposium. And I have to say, although it was an an impressive array of companies, that their market performance, including the great big ones, including the Wheaton Precious and the Agnico Eagles, was really, truly gratifying. And this gratifying share price performance often serves to validate narratives in investors' minds. So it's important that you consider what type of investor or what type of speculator you are and act accordingly in this market. Remember our repeated admonition that money is made in these markets in the delta between price expressed by market cap and enterprise value and net present value, what something sells for versus what it's worth. And remember too that those tools, at least rudimentary tools, are available to you at the Rural Classroom. Finally, a commercial for a couple of things. The part 3 of our great Gold Boot Camp is coming up. Those of you who enjoyed parts 1 and part 2 should stick around for the finale. And the first one we talked about the gold market itself, physical gold, the physical gold proxies. In the second, we talked about the best of the best. Wonderfully timed because those stocks have performed wonderfully well. Now we're talking about the money that cascades down the sector from the best of the best to the best of the rest, to the single asset developers, to the project developers, to the exploration companies. So round three is coming up. Look forward to a really, really, really good boot camp. Remember, too, that if you were unable to attend the Boca Raton Natural Resources Investment Symposium 2025, July 7th through 11th, that the recordings are available for purchase today. And they carry the same ironclad money back guarantee. If you buy the recordings and play the recordings and you don't think that we gave you your money's worth, we will give you your money back. So, Albert, that's probably enough commercial announcements. We should probably get on with the show.
All right, great. In response to that, you put a threshold of 60 months. I think that's what you said, 60 months. That's what you consider trading, a commitment of less than 60 months.
No, I suggested that people who aren't willing to make an 18-month to 2-year commitment, or better, a 60-month commitment, those people who style themselves as traders, and there are a lot of those people who listen to us, those people who regard themselves as traders, if they are trading anti-sentiment, should consider taking profits. I believe that this bull market is very much intact for the reasons that we've talked about so often. Debt deficits, negative real interest rates, social spending, stuff like that. I just think in the near term, this is a crowded trade. And so
Yeah.
traders, people with a short-term orientation, need to consider who they are, and they need to take action that is commensurate with who they are.
Yeah, that makes a lot of sense, Rick. On the other hand, um, these markets don't go up in a straight line, and so there's always the danger of you underestimating the enthusiasm of the investor enthusiasm, and you miss out on a big move because you're out of the market.
Albert, I'm no good at investor sentiment, as you know. I believe that it is more likely than not that over the next 10 years, US dollar loses 75% of its purchasing power. Looking at the 1970s as prologue, I suggest that the gold price, at least in nominal terms, could mirror the decline in purchasing power of the US dollar. That suggests that in baseball parlance, we're in the third inning of a 9-inning game. And so I'm by no means suggesting that people should back out of the precious metals equities trade. I'm only suggesting that they understand who they are, what their precepts are, and what their tolerance for volatility is.
Yeah, Rick, would you say that your advice or your recommendation applies equally to beta and alpha investors, or more
I
to one?
wouldn't. I think that the big companies will continue to sustain a bid because I think we're coming into the period where the generalist investors are tiptoeing into the mining business. They will look for very large companies with very high liquidity, and they will look for companies that meet certain balance sheet and income statement tests. And it might be if somebody wants to stay the beta trade and leave the alpha trade, if that's someone's trading strategy, that they move away from the $300 million market cap and they hide out in the $30 billion market cap. That's anti the way the trade is going in the longer term. Traditionally, what happens is the valuation gaps between the very large and the rest begin to decline. Value arbitrageurs, people like me, move down market looking for valuation arbitrage. To the extent that the valuation arbitrage doesn't happen, what happens is that the big companies with full valuations take over the smaller companies with less full valuations. That notwithstanding, an individual needs to decide what he or she is all about. And if he or she are all about short-term trading, you haven't made the money until you've taken the money. I am not doing that. I am selling some of the positions that I took as a consequence of the fact that I think they were simply oversold. Now that they're not oversold, the reason that I bought those stocks is past, and so the stock has to go. I still have very large positions in the precious metals trade, and I'm actively moving way down market to the prospect generators and the explorers. I'm moving in terms of my profit taking from the $500 million market caps down to the $20 and $30 million market caps. But that's something that I'm psychologically and financially prepared to do. I'm also doing it with a 1.5 to 2 year time frame.
Okay. Two more things I want to talk about before we get to the questions. Rick mentioned boot camp. That's the gold boot camp part 3. You can go to bootcamp.rulclassroom.com for info about that. Bootcamp.rulclassroom.com. That's going to be on October 4th. So check that out. You can also get the archives of the 2 previous boot camps if you haven't seen them. And then, Rick, you and I are both going to be in Vancouver next week. And that's because we're going to be attending and speaking at this show, which is Jayant Bhandari's Capitalism and Morality seminar. It's been going on for many, many years, well over a decade, right, Rick?
Yes, absolutely.
Yeah, well over a decade.
Wonderful seminar, not normally a financial seminar, more a seminar about philosophy, politics, personal responsibility. Although I will admit this year, for the first time I've spoken, that my talk will be more financial. I'll be talking about the mathematics of America, a topic I've discussed a lot about the Rule Classroom. And I'll talk about the importance of non-narrative decisions around your life. So I look forward to giving that talk at the seminar, and I look forward to being there. I will note that I think this year's conference will be particularly interesting. I've combined with Students for Liberty to make available complimentary admission to 30 student libertarians from Southern British Columbia and Northern Washington. So the median age at the conference is going to decline by about 30 years, which I think will be a very good thing. And I look forward to hearing your talk, Albert, at the preceding dinner.
I look forward to giving it, Rick. And it's kind of interesting. So this conference, you never know what to expect. And I'm constantly learning from the people that I hear at this conference. And it's always opening new doors of thought. And I think it's kind of funny that this year, I'm going to be giving a talk about India, and Jayant is going to be giving a talk about China. So we just kind of crossed over. But my friend Stefan Kinsella, who is a prominent libertarian theorist, is going to be giving a talk. And if you haven't heard him speak about intellectual property, it's great stuff. He is one of the pioneers in the libertarian treatment of property rights. So that'll be good. I noticed Jeff Deist is on the roster again. And so it's going to be a lot of fun. And you can find out about that at giantbhandari.com. I think there's still spots available if you want to join. All right. So with that out of the way, Rick, let's get to some of these questions. Got a lot of questions as usual. Let's see. Let's go to this one first. Your opinion on Andian Silver, Rick?
I'm a shareholder of Andian Silver, a small shareholder. I know the deposit from when Mandalay had it. I've always thought there was exploration upside. We're going to find out if there is. Usually later in a bull market, leadership changes from gold to silver. And when that happens, the deserving silver stocks absolutely explode. Make no mistake, right now, this is a silver exploration stock as opposed to a silver stock. Best place to look for silver is in the head frame of a silver mine. The company makes a very compelling case that thus far demonstrated, by the way, with data, that there's a lot of exploration upside here. If the exploration upside exists, and if we move, as I suspect, from a gold-centric market to a silver-centric market, my risk-taking will be rewarded. This is not for the faint of heart. This is not for the short-term oriented. This is not for people who conflate volatility with risk. This will be a volatile stock and likely is a risky stock. But if you're willing to do that, this is the kind of stock where you could, I'm not saying would, where you could see a 10-bagger or a 20-bagger. The stuff that exploration speculation is all about, in my opinion.
Okay. Ross Bartlett is joining us today, Rick, on his boat in Bellingham, Washington. Wants to know how the crabbing's going this season, Rick.
The crabbing this year, if your name is Rick Rule, has been challenging. Precious few eating crab, an awful lot of undersize and female crab. So really, there has been a protein transfer. I a very cheap chicken in my crab pots, and thus far, the amount of protein that I've sacrificed relative to the amount of protein that I've consumed has made it a net trade. I will say I enjoy it, Albert, as you know, immensely. I don't enjoy being outsmarted by an animal with an IQ south of one. And thus far, I mean, I
Yeah.
have to say next year is probably going to be a pretty good year, given the fact that I've captured and released probably 150 female crabs.
All
Uh,
right.
the big male crabs, ones where I get to eat them, have been a bit more scarce.
Interesting. They do have home field advantage there, Rick. So you can be forgiven. Okay. Your opinion on first mining gold and maritime resources?
I don't know enough about First Mining to comment. I'm, as you know, Albert, a friend and fan of Keith Neumeyer, and I suspect were I to study it, I might become more interested in it. Maritime, my only difficulty with it is the deposit's fairly small. I like big deposits. The risks inherent in all mines are high, and the rewards from small mines are small, while the rewards from big mines are big. So I prefer companies where I can easily see million ounce plus in the deposit, and I don't see that here.
Okay. Rick Josh is asking about Mubadala Investments selling their Aris Mining shares.
Interesting. They were big backers of Eris because they were big beneficiaries of the prior effort by these people, Endeavor Mining. I'm not certain about the reason behind the selling, but when you have a sophisticated investor like Mubadala selling, there's usually a reason. Probably a good topic for us to investigate at the Rural Classroom. We should probably bring in Neil Woodyer and interview him and say, "Hey, Neil, if life is so good in Colombia, how did you lose Mubadala?"
All right. Let's do it. That'll be fun. Jay asks your views on Ion Saturn metals.
I'm an IA shareholder, so let's get that out of the way. I have conflicts of interest that really stem from backing Benoit LaSalle for 20 years at Semifo. Saturn, I'm just starting to get to know. I have to say, I like what I see, but I don't own it. I particularly like the fact that Saturn has a godfather in the person of Jonathan Goodman, backing up Saturn with all of the resources and all the brains at Dundee. I guess indirectly, I am a Saturn shareholder because the largest shareholder of Saturn is Dundee, and I'm a large shareholder of Dundee. But as I get to know the company more closely, perhaps that's a topic that we'll return to.
Rick, for these new names, are you still accumulating positions in the space, or do you have to make room in your portfolio every time something catches your eye?
No, I'm not as disciplined as Mr. Buffett would suggest. Mr. Buffett has always said that your portfolio should resemble a hog trough. And if there's room in the trough for 12 hogs, before you add a mean, hungry hog, you have to kick out an old fat hog. And I'm not that disciplined. So I probably own too many stocks, although I will say that I do pay attention to my suggestion there that you spend an hour a month on every stock in your portfolio. Well, I don't do that with regards to Franco, Wheaton, and Agnico. I don't do it with Exxon. I don't. Well, I do it with Cameco because I view Cameco as a way to learn more about uranium. But the smaller stocks, I spend at least an hour on a month for every position I have, and that, Albert, as you know, ends up being a lot of hours.
That is a lot of hours. But Buffett himself, I mean, he holds a lot of cash, Rick,
He does.
which means there is lots of room at that trough. And I assume you're the same, right? You have dry
Uh,
powder.
I do. Well, sadly, Albert, not as much as him. I can only
Or
wish.
gladly, actually.
couple standard deviations less, frankly.
You wouldn't be looking at these companies if you
Yes.
did, right?
No, I have a lot of liquidity. He has a lot of liquidity. He has more of an opinion on the market than I do. He won't say that the market's overvalued, except that he says that the valuation metric that he uses is the ratio between the S&P 500, I think it is, and GDP. And he suggests that by that metric, the market is at historic highs, perhaps twice what the economy suggests. There have been periods of time when the markets have appeared to be fairly frothy, but Mr. Buffett also famously says that the market isn't a topic, that the market is a facility. And there have been circumstances where individual issuers, in his mind, were so attractive that he didn't care much about the market, that he bought the companies where the delta between price and value was in his favor.
I wonder about that metric, Rick. And now, because we live in the world of multinationals, right, where companies can be they can be listed in New York, but they can be domiciled somewhere else, doing business somewhere else, and then not repatriating the profits. Yet you still make money on that, right? So I don't know, does that show up in GDP somehow?
I worry about the metric for a different reason. I think we're in a period now, I think, where technology is such that there are leverage returns on capital employed, that the type of capital investments that are required to generate a unit of utility in many businesses, including technology itself, has gone down. And if that's right, the ability to sustain earnings with lower capital reinvestment should be much better, which would justify higher price earnings. I have certainly seen the impact of technology in the oil and gas business. The fact that, with regard to, as an example, the United States shale business, that exploration expenditures are a thing of the past. That conjunction of three-dimensional seismic, horizontal drilling, and multi-stage fracturing has meant that a smaller amount of capital can be deployed with a higher amount of certainty. And I suspect that that's true across the spectrum of industrial activities. So it occurs to me that the margins being earned on the deployment of capital in businesses where technology has been advancing, including particularly technology itself, means that a higher price earnings ratio is probably justified. The second thing that I think, you can tell I haven't thought this through too well, but the second thing that I think is that a social decision has been made in the United States that we will sacrifice the sanctity of the US dollar in favor of artificially low interest rates, which means that as long as we continue to do this, the cost of capital for those companies with access to capital, investment grade companies, will be lower than we're used to. A circumstance where your cost of capital is constrained and your margins from a historic point of view are higher, again suggests that a higher price earnings multiple is likely justified than was justified when Buffett's supposition of what constituted an overpriced or underpriced market was established. Notice too that I don't hold too much stock in my own opinion about this, but it makes perfect sense to me thinking it through. I'm not opining, by the way, on the value of the big tech stocks. Albert, as you know, many of them produce products I can't pronounce, and so for me, trying to do a valuation analysis on a NVIDIA or a Microsoft or Apple would be very, very, very silly. But I certainly understand the rationale where semi-permanently lower cost of capital and semi-permanent increases in rates of return on capital deployed through technology could justify higher PEs.
That sounds eerily similar to the what's it, Irving Fisher was that his name, the American economist who proclaimed new plateau or something prior to the the stock market crash.
Well, you will note I haven't acted on that supposition.
Yeah, and then as far as the sanctity of the dollar, didn't Nixon make that decision back in the 70s? I think now we're just violating it violently.
Well, you will recall that there was a period, 1981 to 1983, when Mr. Volcker went the other way. It was not necessarily a pleasant time. I remember watching over the course of the decade of the 70s into the early 80s, the prime rate of interest going from 4.75 to 15. That worked a hardship on a lot of folks, myself included. But it did something interesting. It restored global faith in the sanctity of the US dollar. It broke the back of inflationary expectation. And while very clearly, as we demonstrated at the 2025 Natural Resources Investment Symposium, the Reagan Revolution was unsuccessful in reducing the size of government. It was successful in reducing the growth of government. That period, let's call it 1980 or 1981 to 1983, was instrumental in that a paradigm was established that continued through the first term of the Clinton administration, where the growth of government was constrained. And that was important. It set off, I would suspect, a 40-year bull market that probably ended in 2022. So what you say is by and large true. Administrations have decided they can outlaw the business cycle, all that type of thing. Their response to any fiscal crisis seems to be to flood capital markets with liquidity. But there was a brief period, however unpleasant, that went decidedly against that. And it turned out to be an extraordinarily healthy interlude.
Yeah, but note he didn't go far enough, meaning back
Agreed.
to redeemability.
Agreed.
Okay, so let's get back to these questions. Don't want people to get impatient here. Rick, you're ranking about Founders Metals and Osgold.
No rankings on either, although I am an Osgold shareholder.
Okay. How does that happen, Rick? You evaluate a company and take a position, but you don't have a rating. What
Yeah, my ranking is out of date. I haven't looked carefully at the company for a fairly substantial period of time, 9 months, and I don't have enough faith in my historical ranking. I'd rather risk my capital than my reputation.
Yeah, right. Okay. Can you comment on Boss Energy, Rick? Mine production issue and Paladin energy production issue.
I sold my Boss. I know a reasonable bit about in situ recovery, and it involves the predictable and ratable flow of fluid through a sandstone-hosted horizon. To the extent that the horizon is less porous or less contiguous than you had hoped, and those fluid flows are interrupted, you need to get it right. And so I've decided that I will pay up for the stock when, as, and if they can demonstrate to me that they understand the ore body. Until then, I'm going to sit on the sidelines.
Okay.
Paladin is a circumstance that I anticipated. In my own valuations of Paladin, I never used an AISC of 27 or 28 or whatever they talked about in the feasibility study. And the $40, $41 AISC is nothing that surprised me whatsoever. So I'm less surprised by Paladin than I was by Boss. Now, in my own defense, Boss moved so far. You know, it was a 5-bagger during the point in time when I first bought the stock and they first appeared as a guest at our conferences. And the time I had to sell the stock, I had already sold enough stock that I had more than recovered my capital. I was at the point of no concern in Boss a couple of years ago. And what happened with my liquidation, my more recent liquidation, is merely that I gave up some unrealized profits. And that happens. If the information that causes you to be long a stock changes, you need to assess that information fairly quickly, and you need to take some action. What was, I thought, a fairly homogeneous deposit turned out to be substantially less homogeneous. And until they can demonstrate enough understanding of that deposit, um, which is demonstrated in production costs and volume, I'll be gone.
Okay. Let's see. Rick. Jatinder has a question, and that is on Bunker Hill Mining and Cartier Resources. Do you have thoughts and rankings on either of those?
I'm not a shareholder of either. I know the people behind Bunker Hill. I certainly know the deposit. I drove past it a couple weeks ago, and I visited it several times in my life. I have a difficult time understanding ore body continuity with what is left of that deposit. Understand it's been mined for a very, very, very long time. So I'm not a shareholder of Bunker Hill. Cartier, I'm sort of attracted to, but I don't own it. I love the fact that the guy behind it is André Dormant, who was author of a spectacular success I enjoyed called Virginia Gold. I have a high regard for him professionally and personally. I like Quebec as an exploration jurisdiction, both because of its prospectivity and because of the fact that, although it flies in the face of my libertarian leanings, that the government is solidly behind the exploration industry in Quebec rather than being a foe, they're a friend, which is the type of regulatory climate. Well, I would prefer probably no regulatory climate to the effect that those people are lined up on my side as opposed to lined up to arrest me. Yeah, I like that better. But I do not own Cartier. The last time I looked at it, I gave it a ranking of 6. My ranking is suspended because the ranking's out of date.
Rick, how do you rank the various jurisdictions in, let's just say, Canada and the United States? What are top tier
I think
jurisdictions?
all jurisdictions are lousy, Albert. You need to understand in North America, both the United States and Canada, that you have federal, state, and local jurisdiction, and depending on the circumstance, uh, any of those three can claim lead agency status. So, in the United States, as an example, I'm attracted to Texas, I'm attracted to Wyoming, I'm attracted to Nevada, and I'm attracted to Alaska. That's the end of it. But you have to go deeper than that. If you're in the uranium business, as an example, in the state of Wyoming, Sweetwater, Natrona, Fremont, those are good counties because they have established uranium infrastructure. And the regulators in those counties know something about the uranium business. They aren't going to act hysterically. In Canada, I'm attracted in particular to Saskatchewan, less so, but still attracted to Quebec, uh, Alberta, medium attraction to Ontario, uh, opposed to British Columbia, except where in British Columbia you're exploring in the traditional territory of the Nishka or the Tahltan, local bands that I've become familiar with, know and love and trust, and bands that have the political standing in the province to take lead agency status. Ironically, what the industry considered to be their worst foes, the natives are turning out to be their best friends. So it's a nuanced question.
Okay, let's see. Did I ask you about Revival Gold yet? I don't think so.
No, sir.
Okay, what
No, sir. I'm a
Revival Gold
shareholder in
and Azimuth
Revival.
Resources?
I'm a shareholder in Revival. We invited them to the 2025 Natural Resource Investment Symposium. They are involved in attempting to restart a couple historic producers, one of which, Bear Track, I have substantial experience and familiarity with. Hugh Agro, a very high quality guy, the CEO. He's got a tough road ahead of him. Trying to finance. Well, I think he'll try to finance Mercure before he tries to finance Bear Track, and that's the right thing to do. Cheap, cheap, cheap market cap. And I suspect that if the gold price stays at this level, or as I suspect goes higher, that he will ultimately be successful. He's going to have to finance again. What he's involved with has long lead times, permitting is boring and expensive. My fondest dream would be for Revival and Integra to merge. They're both involved in the same activity. Uh, there are all kinds of overlap. You could probably cut out 40% of the combined overheads in doing that. And I think that there would be good human interplay between the management teams of both companies. Of course, this is my idea, not theirs. Probably both senior leaders would like to continue as senior leaders, and there would only be room for one if the overhead was going to be cut. But they're both in the same business.
Okay. Let's see. Here's one from Josh. Your thoughts on rankings for Foran Mining?
Foran's currently unranked. I like what they've been able to do on the exploration side, but I don't know it well enough to either buy it or rank it.
Rick, follow up on Aya Gold on their Q2 earnings, high cash costs. Any comment on that? Any thoughts?
Yeah, that was forecast. They were mining a lower grade part of the deposit, and there was some interruption in production as a consequence of scheduled upgrades. The nature of those narrow vein high grade deposits is that they pinch and swell. You're going to have good quarters. You're going to have bad quarters. I own Aya because I think in the next 2 years, production more than doubles. And I think the more time they spend on the ore body that they're mining now and the second ore body that they're thinking of bringing in production, the more they're able to control the vagaries of distribution and grade control.
Okay. And Equinox Gold.
Equinox is interesting. It's been a real disappointment for me. The most recent quarterly allowed me to breathe finally a sigh of relief. The last 8 quarters have all been disappointing. It's nice to get a good quarter. Specifically, it would seem from this quarter, we'll need next quarter for confirmation, that they've got the hard rock deposit bedded down. Regular listeners to this commentary will remember from past discussions that hard rock was way behind schedule and way over budget. And after that, didn't shake in easily, meaning it didn't go from economic completion to nameplate capacity very smoothly. That's an understatement. It would appear from the last quarter that they're getting their arms around hard rock, which is great. It would appear too that the second Canadian construction project is nearing completion. And as they bed down hard rock and bring the other deposit online, it looks as though the free cash flow growth that they had forecast taking place a year ago takes place now. That will enable them to follow the old Ross Beatty game plan, which is as you bring high quality deposits on, you sell the lower cost deposits off without reducing critical mass. You use the proceeds and management time and attention to make an even higher quality acquisition. I hope that if the next quarter continues the progress at Hard Rock and they get the AASC down to 17 or 1750, which is what they hope to do, that they'll be able to sell Los Feliz. I don't think that team any longer has any business operating in that part of West Mexico. It's too rough. And I hope Ross isn't going to like to hear this, but I hope they sell off the California operations. I don't think they need Mesquite. And I think now that they've gotten the Trump fast track permit for Castle Mountain, that they should sell Castle Mountain and let somebody who needs that asset advance that asset. I'd like to see Ross stick with the higher quality assets around the Caliber acquisition and focus on what he's going to do next, which is, I think, upgrading the entire portfolio.
Last time he didn't like something you said, Rick. He came on the show graciously. So maybe word will get to him and he'll join us here.
I look forward to that. Any conversation that you have with Ross is always an educational opportunity. And anytime that Ross wants to take issue with me, I invite that to happen. I think these are always educational and instructional opportunities for our audience. You will note that he said, that they were going to prevail in Ecuador, and it would seem that he was in fact right.
Okay. question from Rahul. Rick, it's multi-part, but I'll just start with the one at the top here. There's increasing, I guess, friction between the U.S. and Canada, the U.S. and a lot of nations, frankly, for that sake. But his concern is, will that create a hostile environment in Canada for U.S. capital? And is that something that we should be concerned about?
There's always been a love-hate relationship between Canadian issuers and American capital. One of my own experiences has been building businesses in Canada and owning real estate in Canada. I was rewarded for that by the government of British Columbia and the government of the People's Republic of Vancouver, hitting me with a vacant home tax and a speculator's tax and all those things. When I was unable to occupy my condo as a consequence of COVID, rather than giving me injunctive relief, they tripled the vacant home tax. So to describe Canada as a benign place to put American capital is to evidence naivete. I remember earlier in my career in 1977, when I was living full-time in Canada, the first Trudeau, the terrible T, instituted something called the National Energy Policy, which taxed American investors in Canadian oil and gas at twice the rate of Canadian investors. Fast forward to 1995, 1996, when the gas price went up and the province of Alberta tripled the royalty on natural gas. The idea that Canada is a particularly safe place for American capital as a consequence of the 49th parallel is probably misplaced confidence. I note, too, that the new Prime Minister of Canada, Mr. Carney, overtly ran against Trump, which is probably why he got elected. I'm not a Canadian citizen. I didn't see the ballot, but I strongly doubt that Trump was on that ballot. That notwithstanding, Mr. Carney focused his campaign on Trump, which was highly successful. So I think that there's fertile ground in Canada for a jingoistic response to the idiocy of Trump. Referring to Canada as the 51st state. Referring to Trudeau, however funny it was as Governor Trudeau. This idiotic tariff policy where he proposes and rescinds tariffs, probably based on who makes promises of campaign contributions to him, is really fertile ground for the sort of jingoistic response, Canadian nationalist response, that one would expect anyway. I think it'll give cover, intellectual cover, for what large portions of the Canadian electorate would like to see anyway.
Yeah, okay. And then, so moving on, different topic here. He's talking about the Lassonde curve, Rick, with respect to Dakota Gold, and asks, how does one identify a company entering the trough in the Lassonde curve? Maybe for new people, you could explain what the Lassonde curve is.
The Lassonde curve is a description of prior market conditions that may or may not be present now by Pierre Lassonde, who is a truly spectacular gold investor and a wonderful human being. And it describes several phases in the speculative and investment cycle around a gold company, from the construction phase through the exploration phase, and it assumes exploration success, where there's an explosive up move based on the discovery. And then post-discovery, when the news is no longer about something that excites the market, which is to say exploration results, through the pre-feasibility study, through the permitting phase, that's called the boring cycle. That's when real work is taking place, but reality is setting in. At the end of that, and I would refer people to Lobo Tigre's work around the Golden Runway, the Lassonde curve, the boring part of the Lassonde curve would appear to end when the permits have been obtained and production financing has been obtained, and the shovels begin to turn. I suspect, with regards to Dakota Gold, that we are still very, very, very much in the discovery phase. It's important to note at Dakota that there are actually three styles of discovery. There's the ability to do on strike and at depth extension to the original lode. The lode itself is owned by the state of South Dakota. There is another exploration effort which has been reasonably successful at looking at on echelon structures. That is to say, the fact that the structure could and in fact does repeat. And then there was the discovery to the west of the deposit, between the Homestake deposit and the Wharf mine, of the surface expression, the likely surface expression of the deposit in oxides. That third part of the potential is what we're seeing the market's reaction to today. I think there's a reasonable bit of discovery still to go there. I note that they don't even have a pre-feasibility study on that deposit. I would suggest too that there is an outlier, and that is this. The state of Dakota was given the producing mine and the remaining gold mineralization. That mine didn't shut down because gold was exhausted. That mine shut down because gold was exhausted that could be produced profitably at $250 an ounce. Gold is no longer at $250 an ounce. Political forces in South Dakota have expressed solid support of this mine. And one thing that I think is an outlier, but a possibility, is that Quartermain could buy the original mine from the state of South Dakota. They are clearly not going to mine the remaining high-grade mineralization. And I think that could really be a game changer. I'm not suggesting that this is a certainty or even a probability, but I think it's a possibility. And so I think there's something around Dakota that sits outside the normal boundaries of the Lassonde curve.
Okay, thank you for that. His last question concerns MP Metals, Rick. Sorry, MP Materials. Do you think there is still room to run with ongoing production and guaranteed off-takers?
Still room to run, yes, but I've watched that deposit go broke at least twice in my career. This is not the highest grade or highest quality rare earth deposit in the world. It is the best located on Interstate 15 between Los Angeles and Las Vegas. It is an American deposit. It's a large deposit. Metallurgically, it's a lousy deposit. The reason, I guess one of the reasons why I got so much federal support is it needed it. It is not a standalone deposit. The consequence is that I don't own it. If you ask me if it has room to run, I think rare earths have a lot of room to run. And this would seem to be a deposit that will enjoy continued federal support.
Question from Marco, Rick, asking about your opinion on Tier 1 silver and BlackRock silver.
I don't own either of them. The Tier 1 team, I like a lot. I like their exploration thesis. I'd rather pay up for that if I had more data. BlackRock, I don't know enough about to comment.
Okay, and then he follows up with a question for me, actually, and that is how to use some AI tools or which ones for financial investing purposes. I haven't done that, but Rick, I've seen accounts of these platforms making pretty bad mistakes on legal documents and whatnot. So from what I've seen, really these things are useful only as to fill the function of maybe a low-level assistant. And whoever it is, the accountant, the analyst, the lawyer, the MD, really still has to go through that material as if, like I said, it was produced by a low-level assistant. Do you have any experience with that?
Albert, I note that you're too polite to describe my technological competence on air. But I also know that you know about my technological competence. Used improperly, AI stands for artificial idiocy. I have used AI a little bit, Grok in particular, and it would seem that if you ask Grok an unconstrained question, what they do is conduct an informal poll of the postings on X, which is to say that you get the prejudices of 600 million people. I have watched intelligent AI practitioners. I think that we have a couple in the Rule Classroom. Helen G comes to mind as an example, that have asked AI a question that's been properly constrained. and gotten very, very, very good answers. I think if you constructed a matrix of questions around financial performance of mining companies, and you constrained the search ellipsoid that AI was able to search to the Edgar database, I think it would likely be possible to compare 20 mining companies around various efficiency measures, the same work that you'll recall Jeff Howard used to do in the oil and gas business. And I suspect that AI would be able to assemble and correlate the information that you needed in 2 or 3 minutes, the type of exercise that used to take Jeff Howard 6 weeks. And I hope, rather than teach, I hope to use the facility of the Rural Classroom so that some of the people in the Rural Classroom who are more familiar with AI can teach me, or at least we can have a teach-in, so that we learn how to use AI to do the grunt work in financial analysis.
Rick, just a comment on your technical acumen. I think you overestimate the complexity of this stuff and you underestimate your own ability, to the point where when I'm on a stream now with Adrian or Joe and something goes wrong, we blame you because you set yourself up for it.
Well, it's also because your experience suggests that there's a probability of my error as opposed to a
right, even when you're not there. But regarding the your proposed application of AI, that's precisely what I've seen. And what I've seen is that although the report may look like something and read like something that someone like Jeff Howard has produced, it is in fact not to that quality. And I don't know if that's something that has to be fixed, that can be fixed, or if it's going to be with us for some time. But I wouldn't trust it to the level of that I trust something from like a guy like Jeff Howard at this point.
AI has no common sense. And it's very important that when you construct a decision-making tree on AI, that you not allow AI to construct it. It's important that you frame relevant as opposed to popular questions, and that you constrain the search universe very, very, very well. You'll note, by the way, that I'm speaking conceptually. I haven't done this. I do remember, I think you were there back at Global, when I first learned how to construct spreadsheets on Bloomberg, and the amount of work that Bloomberg was able to do, going back over 5 years of annual reports and quarterly reports. I mean, Bloomberg didn't have to pull staples. They could search databases. But again, with Bloomberg, it was very, very important that you framed the question, that you didn't allow the algorithm to frame the question, because although the algorithm could search huge amounts of data and correlate it for you, the algorithm had no common sense. It didn't know itself how to translate that data into knowledge. That's something you have to do.
Yeah, but Bloomberg doesn't claim to be what AI is claiming to be. So that I think that's okay. It's not a failure on their part. But Rick, one thing I'll add, I have been messing around with AI for some of the research I'm doing for the talk next week. And I would say pretty conclusively, you can't trust it for historical perspectives and political, political research. And to the extent that AI is now sort of superseding traditional search, like you search something in Google or Bing and you get their AI instead.
Our
the results
mutual
are
friend,
just not, they're very biased now.
Our mutual friend, George Gammon, has in his podcast twice debated an AI opponent. And that's actually something that you and I might consider doing.
I've done that, Rick. And then I realized at some point that I'm arguing with a machine. It's not worthwhile, but I did capture one of those transcripts and I'll be presenting it next week at Giant's dinner. It's very funny.
I look forward to that.
This thing is okay. So running out of time here, Rick. So let's just get one more in. B says, do most Australian companies restrict US accredited investors from participating in their private placements?
Absolutely not. Most Australian dealers try to favor their best customers, and so you must establish a relationship with the gatekeeper, which is to say the dealers. If the questioner attended the Natural Resource Investment Symposium, 2025, where, if my memory serves me correct, we had 5 or 6 Australian issuers. What you do if you're interested in participating in an Australian private placement is make your wishes known to the management team. Get on something called the President's List. That's very, very, very available. One of our issuers, Centaurus, we said at the, not Centaurus, I'm sorry, Meteoric, Meteoric and Centaurus both were at the conference needing money. It was very obvious to me that both people were going to issue shares in return for money. The way you get on the list is get on the list. Talk to the investor relations guy, talk to the CEO, talk to the CFO, say, it appears to me from your balance sheet and income statement, you're going to have to go to market. Depending on price and terms, I'd like to participate. Please take my name down and please contact me. Believe me, they will.
Okay, and we are straight out of time. So one more plug for Giants conference. That's on Saturday. Next, I guess Saturday the 23rd in Vancouver. GiantBandari.com is where you can find out about tickets. It's going to be a lot of fun, and we always have a lot of fun before, during, and after the show. So, Rick, any last thoughts? We gotta close here, but any last thoughts?
Simply that I want to encourage people to continue to use the educational facility at the Rural Classroom. A lot of the questions that are being asked would be better understood to the extent that the people posing the questions had taken the time in particular to review the series Introduction to Natural Resource Investing, where we teach the lessons that come to the conclusions that y'all are asking me for. I enjoy these discussions. I enjoy talking to people, but my answers would have better context to the extent that the people asking them had prepared themselves better using the resources here at the classroom.
Yeah, a lot of familiar themes. The small mine theme is one, as an example, but it takes a while for these lessons to sink in, Rick. I've heard them many times, and I still benefit from having them repeated now and then. But ruralclassroom.com is where you can get that. And that series is available, free of charge, for anyone who wants to go. And Rick goes through about 14 lessons of just the basics for the natural resource retail investor, something that everyone should take advantage of. So please do that.
Since we have time, I've been involved in 2 discussions this week with the Colorado School of Mines about having Rural Investment Media and the Rural Classroom joint venture, a short course on mining industry valuation. It would appear that the Colorado School of Mines is seriously interested in doing that with us. I have one prior educational joint venture with the Colorado School of Mines going back to 1996, the Mining Investment College, which was a highly, highly, highly successful short course that we did with them. So I will keep our students actively appraised of those discussions. This would likely be a 4-day short course in Golden, Colorado, at the campus of the Colorado School of Mines. It would likely, provided that Albert wants to do it, be simulcast and live stream or something else so that you wouldn't have to be present to attend. I need to say that this would not be a course for tourists. This would be likely 3.5, 8-hour days. That would be extremely intense. But for those of you who are interested, enough of you have expressed interest, that we're pursuing this with the Colorado School of Mines. So keep this in mind if you're seriously interested in learning how to invest in natural resource companies.
There has been interest, Rick, in the community and in the chat. So please keep us updated on that.
Will do.
Okay, and with that, we'll conclude. Thank you, Rick, for your time, and look forward to next time. And thank everyone out there for the questions again.
Always a pleasure, sir. I look forward to seeing you at Capitalism and Morality.
All right, take care.